Well, you know, I've been doing this for a very long time, longer than most of you have been alive. I have seen markets rise and I have seen them fall. I have watched fortunes made and fortunes lost. I have lived through recessions, depressions, crashes, and recoveries. And in all those years, through all those cycles, I have learned one thing above everything else. When something does not feel right, when the numbers stop making sense, when everyone around you is acting like the party will never end, that is exactly when you need to pay the closest attention. Now, I do not say this lightly. I really don't. I am not someone who goes around ringing alarm bells every time the market hiccups. That is not my style. Never has been. I have always believed in the long-term strength of American business, in the resilience of our economy, in the power of compounding returns over decades. But I also know that there are moments, rare moments, when you have to step back and look at what is really happening. Not what people are saying on television, not what the headlines are screaming, but what the actual data, the actual behavior of markets and governments and institutions is telling you. And right now, what I am seeing concerns me deeply. It concerns me in a way that I have not felt since 2008, maybe even more than that. Because back then, we knew what the problem was. We could see the housing bubble. We could see the leverage. We could see the derivatives piling up like kindling waiting for a spark. This time it is different. This time, the problems are not in one sector or one kind of asset. They are everywhere. They are in the structure of our debt, in the policies of our government, in the behavior of investors who have never known a real bear market, in the assumptions we have all made about how the world works. Let me be very clear about something. I am not telling you to panic. Panic is the worst thing you can do with your money. Panic is what destroys wealth. Panic is what turns a bad situation into a disaster. What I am telling you is to wake up, to look around, to understand that we are living through a very unusual period and that the rules that worked for the last 15 years might not work for the next 5. You see, after the financial crisis, something changed in how our economy operates. The Federal Reserve and central banks around the world, they stepped in with a level of intervention we had never seen before. They dropped interest rates to zero. Then they went below zero in some countries. They printed trillions of dollars. They bought bonds. They bought mortgage securities. They propped up markets in ways that would have been unthinkable when I started out in this business. And for a while, it worked, or at least it seemed to work. Markets went up, housing recovered, unemployment fell, people felt wealthier. But here's the thing about artificial stimulation. It does not fix the underlying problems. It just postpones them. It pushes them further down the road. And the longer you postpone a problem, the bigger it gets when it finally arrives. Now, I want to talk specifically to those of you who are over 60 years old. And I am saying this as someone who is well into my 90s. If you are over 60, you do not have the luxury of time that a 30-year-old has. You cannot just ride out a 10-year bear market and wait for things to recover. You cannot afford to lose half your savings and then spend the next decade trying to get back to even. Your window for recovery is smaller. Your margin for error is thinner. And that means you need to be more careful, more thoughtful, more deliberate about how you are positioned right now. I have been watching something very closely over the past few years. Berkshire Hathaway, the company I have built over 6 decades, has been sitting on more cash than we have ever held in our history. Over $300 billion at last count. Now, people ask me all the time, Warren, why are you not putting that money to work? And my answer is simple. I cannot find anything worth buying at these prices. Think about what that means. I have a team of very smart people. We have access to every deal, every opportunity, every company that comes on the market. We can buy entire businesses. We can buy stocks. We can invest anywhere in the world. And yet, we are choosing to sit in cash and treasury bills, earning practically nothing, rather than deploy that capital into investments. That should tell you something. That should tell you that even at my age, with all my experience, I cannot look at the current market and see value. I see risk. I see prices that do not make sense. I see a disconnect between what assets cost and what they are actually worth. Now, some people say, well, Warren has always been conservative. He has always looked for a margin of safety. And that is true. I have. But this is not about being conservative. This is about being rational. When you pay too much for an asset, no matter how good that asset is, you are setting yourself up for poor returns. And right now, people are paying too much for almost everything. Stocks are expensive by nearly every historical measure. Real estate in many markets is at or near all-time highs. Bonds, well, bonds have been a disaster for the past few years, and they might get worse before they get better. Even commodities, even alternative investments, they are all priced as if the good times will roll on forever. But the good times do not roll on forever. They never have, and they never will. That is not pessimism. That is not being negative. That is just reality. That is the nature of markets and economies and human behavior. We go through cycles. Always have, always will. And right now, we are very late in a very long cycle. You know, I remember back in the late 1990s, I was called all sorts of things. Old-fashioned, out of touch, a dinosaur. Because I would not buy technology stocks. I would not pay 50 times earnings for companies that had never made a profit. Everyone else was getting rich. The newspapers were full of stories about day traders making millions. Young people were quitting their jobs to trade stocks full time. And there I was, sitting on the sidelines, looking like a fool. And then, well, you know what happened? The bubble burst. Trillions of dollars of wealth vanished. Companies that were worth billions went to zero. People lost their retirement savings. And suddenly being old-fashioned did not look so bad anymore. Suddenly paying attention to things like earnings and cash flow and actual business fundamentals seemed pretty smart. I bring this up because I see some of the same patterns now. Not exactly the same, nothing ever is, but similar enough to make me very uncomfortable. I see speculation. I see people buying things not because they understand the underlying value, but because they think someone else will pay more for it tomorrow. I see leverage. I see debt. I see assumptions that have not been tested by hard times. And most of all, I see complacency. People have forgotten that markets can go down, that they can stay down for years, that sometimes the best return you can get is not losing money. Now, let me talk about what is different this time, because every crisis is different in its own way. Back in 2008, the problem was private debt. It was banks and households and companies that had borrowed too much. This time, the biggest problem is government debt, and that is a much harder problem to solve. You see, when a company or a household gets in too much debt, they can declare bankruptcy, they can restructure, they can start over. It is painful, but there is a mechanism for dealing with it. When a government gets in too much debt, especially the government of a major country like the United States, the options are much more limited. You cannot just declare bankruptcy. You cannot just walk away from your obligations. You have really only two choices. You can default, which would be catastrophic for the entire global financial system, or you can inflate your way out of it, which means printing more money, which means the value of every dollar you have saved becomes worth less and less. Right now, our national debt is over $30 trillion. That is trillion with a T. It is larger than our entire economy, and it is growing every single year. We are adding trillions more in new debt. And here is the thing that should really worry you. Interest rates have gone up. For 15 years, the government could borrow money for almost nothing, 1%, 2%, sometimes less. So even though the debt was growing, the cost of servicing that debt was manageable. But now, rates are higher, 4%, 5%, even more for longer-term bonds. And that means the government is spending more and more of your tax dollars just to pay the interest on the debt, not to pay down the principal, not to fund new programs, just to service the interest. Do you understand what that means? It means less money for everything else. Less money for infrastructure, less money for defense, less money for Social Security and Medicare, which, by the way, are already facing their own funding crisis. And it means that eventually something has to give. Either taxes go up dramatically, or benefits get cut, or the government prints more money and we get serious inflation again. None of those options are good for people who are trying to live on a fixed income in retirement. And this is why I am speaking up now. Because if you are over 60, you need to understand what is coming. You need to understand that the financial environment you are going to be living in for the next 10 or 20 years is probably going to look very different from the last 10 or 20 years. The strategies that worked during a time of falling interest rates and unlimited government support, they might not work anymore. The assumptions you made about how much your portfolio would grow, about how long your money would last, those assumptions might need to be revised. Now, I want to be very clear. I am not saying sell everything and hide under your bed. I am not saying put all your money in gold or canned goods or whatever the doomsday people are selling these days. What I am saying is that you need to be realistic. You need to be conservative. You need to have a plan that accounts for the possibility, maybe even the probability, that things are going to get harder before they get better. Let me tell you what I would do if I were in your position. Actually, let me tell you what I am doing, because I am in your position. I am over 90 years old. I have more money than I could ever spend. But I still think about these things every single day. And here is what I believe. First, you need cash, real cash, money in the bank, money in treasury bills, money that you can access if you need it. Not everything, but enough to cover at least a year or two of living expenses, maybe more if you can afford it. Because when markets fall, and they will fall, you do not want to be forced to sell your investments at the worst possible time just to pay your bills. You want to have a cushion. You want to have flexibility. Cash gives you that. Second, you need to own things that have real value, not speculative value, not what someone might pay for it in a bubble, but actual, tangible, understandable value. Good businesses with strong balance sheets and consistent earnings, companies that make products people need, not want, but need, utility companies, healthcare companies, consumer staples, boring stuff, the kind of stuff that does not make you rich overnight, but also does not go to zero when the market crashes. Third, you need to be very careful with debt. If you have a mortgage, if you have credit card balances, if you have borrowed money for any reason, now is the time to think about paying that down. Because when times get tough, debt becomes a burden, becomes a weight around your neck, and it limits your options. You want to go into a crisis with as little debt as possible, ideally with no debt at all. And fourth, you need to lower your expectations. I know that is not what you want to hear. I know everyone wants to believe their retirement account is going to double in the next 5 years, but that is probably not realistic. If you can preserve your wealth, if you can earn enough to keep up with inflation, if you can make it through the next few years without major losses, that might be a very good outcome. Better than what most people will achieve. You see, the hardest thing for investors to do is nothing. We all want to be active. We all want to be making moves, chasing returns, finding the next big thing. But sometimes the smartest move is to just sit tight, to accept lower returns in exchange for lower risk, to focus on not losing rather than on winning big. I have watched a lot of people make a lot of mistakes over the years. And you know what the biggest mistake is? It is not buying the wrong stock. It is not missing out on some big opportunity. The biggest mistake is losing money you cannot afford to lose at a time in your life when you cannot recover from it. That is the mistake that ruins retirements. That is the mistake that forces people to go back to work in their 70s. That is the mistake that turns what should be your golden years into years of stress and worry and regret. And right now, I see a lot of people setting themselves up for exactly that mistake. I see people who are heavily invested in stocks that have gone up so much they think it will continue forever. I see people who have never experienced a real bear market, who do not understand what it feels like to watch your account balance drop by 30%, 40%, 50%. I see people who are counting on their investments to fund their retirement, but who have not stress tested those plans against what happens if the market goes down and stays down for 5 years or 10 years. Let me tell you something about bear markets. They are not just about numbers going down. They are psychological, they are emotional, They test your resolve in ways you cannot imagine until you live through one. When you watch your life savings shrink day after day, week after week, month after month, it does something to you. You start to panic. You start to think, maybe I should just sell everything and stop the bleeding. And that is exactly when most people make their worst decisions. They sell at the bottom. They lock in their losses. And then when the market eventually recovers, they are sitting on the sidelines in cash, too scared to get back in. I have been through, let me count, I've been through at least a dozen serious market downturns in my career. And I can tell you that every single one of them felt like the end of the world at the time. Every single one had people saying, this time is different. We are never coming back from this. The whole system's going to collapse. And you know what? We always did come back. Eventually, but eventually can be a long time. And if you are over 60, you might not have time to wait for eventually. That is why I keep coming back to this point. If you are young, if you are 30 or 40 years old, you can take risks. You should take risks. You have time to recover. You have decades of earning power ahead of you. You can ride out the storms. But if you are older, if you are already retired or close to it, you have to play a different game. You have to focus on preservation. You have to focus on security. You have to be willing to give up some upside in exchange for protecting your downside. Now, let me talk about something that I think is not getting enough attention, and that is the risk to fixed income, to bonds. For most of your lives, bonds were considered the safe part of your portfolio. You put your risky money in stocks and your safe money in bonds, and that made sense for a long time. Bonds were stable, they paid interest, they were there when you needed them. But over the last few years, bonds have not been safe at all. They have lost value. In some cases, they have lost a lot of value. And I think that trend might continue. You see, when interest rates go up, bond prices go down. That is just how it works. It is mathematics. If you bought a bond 5 years ago that pays 2% interest, and now new bonds are paying 5% interest, nobody wants your old bond anymore. They would rather buy the new one. So the value of your bond goes down. And if you need to sell it before it matures, you take a loss. Now, the Federal Reserve spent years keeping interest rates artificially low. They had to after the financial crisis. But that created a situation where people were buying bonds that paid almost nothing just because there was no alternative. And now that rates have gone up, all those bonds are underwater. People are sitting on losses they never expected. And if rates keep going up, or even if they just stay where they are, those losses might get worse. So what do? Well, if you own individual bonds and you can hold them to maturity, you will get your principal back. That is fine. But if you own bond funds, which a lot of people do through their retirement accounts, you do not have that option. Bond funds do not mature. They just go up and down in value based on interest rates. And right now, they are not a great place to be. This is why I have been saying that cash and short-term treasury bills make more sense right now than longer-term bonds. You give up a little bit of yield, sure, but you also avoid the risk of rates going higher and your principal going down. And in an environment like this, avoiding risk is more important than chasing yield. Let me tell you about another thing that worries me, and that is the behavior of younger investors. Now, I am not talking about all younger investors. There are plenty of smart, disciplined young people out there. But there is also a whole generation that has only known markets going up. They started investing after 2009. They have never seen a real crash. They have never seen their portfolio cut in half. They have never had to sit through years of flat or negative returns. And because of that, they have developed some very dangerous habits. They trade constantly. They chase trends. They buy things because they saw it on social media. They use leverage, borrowing money to amplify their bets. They treat investing like gambling. And for the last 15 years, they have been rewarded for it. The market kept going up. Speculation kept working. Even the dumbest trades eventually made money if you just held on long enough. But that is not normal. That is not how markets work over the long run. And when this cycle turns, and it will turn, a lot of those people are going to learn some very expensive lessons. The problem is when they learn those lessons, it affects all of us. When millions of people start selling at the same time, when they start pulling money out of the market, it creates a downward spiral. Prices fall, which causes more people to sell, which causes prices to fall more, and before you know it, you have a panic. Now, why am I telling you this? Because you need to understand that the market is not just a collection of rational investors making careful decisions. It is made up of human beings with emotions and biases and fears. And those emotions can drive prices to extremes in both directions. They can drive them too high during good times and too low during bad times. And if you are not prepared for that, if you do not have a plan for how to handle it, you are going to get hurt. I want you to think about something. Right now, today, if the market dropped by 20% tomorrow, how would you feel? Would you panic? Would you sell? Would you be able to sleep at night? If the answer is no, if a 20% drop would cause you real distress, then you are taking too much risk. You need to dial it back. You need to move some money into safer assets. Because I am telling you, a 20% drop is not only possible, it is probable at some point in the next few years. And let me be even more blunt. A 20% drop might be the good scenario. I have lived through drops of 30%, 40%, even 50%. The crash of 1973 to 1974, the market lost nearly half its value and took years to recover. 2000 to 2002, we lost almost half again. 2008, same thing. It happens more often than people think. And it always happens when everyone is convinced themselves that it cannot happen anymore. You know what the most dangerous words in investing are? This time is different. Every bubble, every mania, every crash, people say those words. They say, oh, we have learned from the past. We have better technology now. We have better regulations. We have smarter people in charge. And then it all falls apart anyway. Because human nature does not change. Greed and fear do not change. The basic laws of economics and mathematics do not change. Right now, I hear a lot of people saying this time is different because of artificial intelligence, because of technology, because we have these amazing new tools that are going to transform everything. And you know what? They might be right. AI might be as big as the internet. It might change the world. But that does not mean that the companies working on AI are worth what people are paying for them right now. Remember, the internet did change the world. It was as big as everyone said it would be. But most of the companies that were supposed to dominate the internet went bankrupt. Most of the investors who bet big on internet stocks in 1999 lost everything. The technology can be real and revolutionary and still not justify the valuations. That is the part people forget. They get so excited about the future that they stop thinking about what they are actually paying for that future. And when you pay too much, even for something great, you get poor returns. That is just reality. Now, I want to talk about something that affects a lot of people over 60 specifically, and that is healthcare costs. Because this is the wild card in retirement planning that nobody really wants to think about. You can save diligently for decades. You can build up a nice nest egg. You can have your budget all figured out. And then you or your spouse has a serious health issue, and suddenly all those plans go out the window. Healthcare in this country is expensive. It is getting more expensive every year. And even with Medicare, even with supplemental insurance, there are costs that can devastate a retirement budget. Long-term care, prescription drugs, treatments that are not fully covered, the list goes on. And as you get older, the likelihood of needing expensive medical care goes up dramatically. So when I talk about being conservative with your investments, when I talk about having cash reserves, this is a big part of why you need a buffer. You need resources that you can tap into if something unexpected happens. And medical expenses are one of the biggest unexpected things that can happen in retirement. I have seen people who did everything right, who saved and invested wisely, who lived modestly, and they still ran into trouble because of healthcare costs they did not anticipate. This is another reason why you cannot afford to take big risks with your money at this stage of life, because you might need it. Not for luxuries, not for vacations, but for survival, for keeping yourself healthy and independent and able to live with dignity. And if that money is tied up in investments that have crashed, if you have to sell at a loss just to pay medical bills, that is a tragedy. That is something you want to avoid at all costs. Let me shift gears a little bit and talk about Social Security, because I know a lot of you are depending on it, and you should be. You paid into the system your whole working life. You earned that benefit. But I also want you to understand that Social Security is facing some serious challenges. The trust fund is projected to run out of money in the next decade or so. Now, that does not mean benefits will go to zero. Even if the trust fund is depleted, there will still be money coming in from payroll taxes. But it does mean that benefits might have to be cut by 20%, 25%, something in that range, unless Congress acts to fix the problem. And you know what? Congress might fix it. They might raise the payroll tax cap. They might increase the retirement age. They might means test benefits so that wealthier recipients get less. There are options, but all of those options involve paying for somebody. And the longer they wait to act, the more painful the fixes become. So I would not count on your Social Security benefits staying exactly as it is right now. I would plan for the possibility that it might be reduced. I would make sure your retirement budget can handle a 10% or 20% cut in that income stream. Again, I am not trying to scare you. I am trying to help you be realistic. I am trying to help you plan for scenarios that might actually happen, not just the best case scenario where everything works out perfectly. Because if you only plan for the best case and something else happens, you are in trouble. But if you plan for challenging scenarios and things turn out better than expected, well, that is a nice problem to have. You know, one of the things I have always believed in is having a margin of safety. That is a term my mentor Ben Graham taught me more than 70 years ago. A margin of safety means you do not cut things too close. You do not assume everything will work out exactly as planned. You build in room for error. You prepare for things to go wrong. And that way, when they do go wrong, and they will, you are still okay. In investing, a margin of safety means not paying full price for an asset. It means buying something for less than you think it is worth so that even if you are wrong about the value, you still do not lose money. In retirement planning, a margin of safety means having more savings than you think you need. It means spending less than your budget allows. It means keeping some powder dry for emergencies. It means not assuming that your health will be perfect or that your investments will always go up or that your expenses will never increase. And right now I see a lot of people who do not have that margin of safety. They are living right up to the edge of what their resources can support. They are counting on everything going right. And that worries me because everything does not always go right. In fact, things go wrong more often than they go right. And if you do not have room for error, if you do not have a buffer, you are one piece of bad luck away from a real crisis. So what does having a margin of safety look like in practical terms? It means if you think you need $500,000 to retire, you save $600,000. If you think you can safely spend 4% of your portfolio each year, you spend 3%. If you think you will live to 85, you plan for 95. You build in cushion. You give yourself room to be wrong. And that cushion, that room for error, that is what lets you sleep at night. That is what lets you weather the storms without panicking. Now, I want to address something that I know is on a lot of people's minds, and that is inflation. We went through a period recently where inflation was running at 7%, 8%, 9%, the worst we had seen in 40 years. And even though it has come down from those peaks, it is still higher than it was for most of the last decade. And I think there is a real risk that we see more inflation in the years ahead, not less. Why do I think that? Well, for one thing, we have not solved the underlying problems that caused inflation in the first place. We still have massive government deficits. We still have supply chain issues. We still have labor shortages in key industries. We still have geopolitical tensions that drive up energy prices and commodity prices. And most importantly, we have a political system that seems unable or unwilling to make the hard choices necessary to get spending under control. You see, fighting inflation requires discipline. It requires raising interest rates even when it hurts. It requires cutting government spending even when people complain. It requires accepting some short-term pain in exchange for long-term stability. And I am not sure we have the political will to do that anymore. Every time the economy slows down, every time unemployment ticks up a little bit, there is enormous pressure to cut rates, to spend more money, to stimulate the economy. And that is how you get inflation. That is how you debase the currency. That is how you destroy the value of people's savings. And if you are living on a fixed income, if you are depending on savings that you accumulated over your working life, inflation is one of the biggest threats you face. because it is a silent thief. It does not announce itself. It just slowly, quietly erodes your purchasing power. What costs $100 today costs $105 next year and $110 the year after that. And if your income is not keeping up, if your investments are not growing faster than inflation, you are getting poorer every single year, even if the numbers in your account look the same. This is why I keep coming back to the importance of owning real assets. Stocks in good companies, real estate if you can manage it, things that have intrinsic value that can adjust to inflation over time. Cash is important for short-term needs, but over the long term, cash gets destroyed by inflation. Bonds get destroyed by inflation if rates do not keep up. You need to own things that can maintain their value in real terms, not just nominal terms. Let me tell you a story. Back in the 1970s, we had a period of very high inflation, double-digit inflation at its peak. And I watched a lot of people, good people, hardworking people who had saved their whole lives. I watched them struggle because the money they had put away was not worth what they thought it would be worth. A pension that seemed generous when they retired was barely enough to live on 5 years later because prices had gone up so much. Savings accounts that were supposed to be safe actually lost value in real terms because the interest rate was lower than inflation. And I am worried we might be heading back towards something like that. Maybe not as extreme, maybe not double-digit inflation, but persistent inflation of 4%, 5%, 6% that is enough to do real damage over time. And if that happens, a lot of people who think they have enough saved for retirement are going to discover they do not. They're going to discover they have to cut back on their lifestyle. They're going to discover they have to make tough choices they never expected to make. So what do you do about it? Well, first, you build it into your planning. You do not assume inflation is going to be 2% forever. You assume it might be higher. You assume your expenses are going to go up faster than you would like, and you make sure your plan can handle that. Second, you own assets that can benefit from inflation or at least keep up with it. And third, you stay flexible. You do not lock yourself into fixed expenses that you cannot adjust if inflation turns out to be worse than expected. Now, let me talk about one more thing that I think is critically important, and that is the risk of fraud and scams. Because as you get older, you become a bigger target. There are people out there who make a living preying on seniors. They call them up and pretend to be from the IRS or Social Security. They send emails that look like they are from your bank. They pitch investment opportunities that sound too good to be true because they are too good to be true. And every year, billions of dollars get stolen from older Americans through these kinds of schemes. I have seen it happen to people I know, smart people, educated people, people who were successful in business, and they still got taken because these scammers are good at what they do. They are professionals. They know how to sound convincing. They know how to create urgency. They know how to exploit trust and fear and confusion. So I am telling you right now, be paranoid. Be suspicious. If someone calls you out of the blue with an investment opportunity, hang up. If someone emails you asking for personal information, do not respond. If something sounds too good to be true, it is. There are no secret investment strategies that will double your money with no risk. There are no government programs that are going to send you thousands of dollars if you just provide your bank account number. It is all lies. It is all designed to separate you from your money. And beyond the outright fraud, there are also a lot of what I would call legal scams. Financial products that are designed to sound good but are actually terrible deals. Annuities with huge fees and surrender charges. Life insurance policies that are really investment vehicles with layers and layers of costs. Reverse mortgages that can leave you or your heirs in a bad position. I am not saying all of these products are bad in all situations, but I am saying that they are often sold to people who do not fully understand them and who would be better off with something simpler and cheaper. My advice is to keep things simple. Do not buy financial products you do not understand. Do not work with advisors who make money by selling you things. If you need help, find a fee-only advisor who works for you, not for some company that is trying to push products. And always, always get a second opinion before making any major financial decision. Talk to someone you trust. Sleep on it. Do not let anyone pressure you into acting quickly. You worked hard for your money. You sacrificed, you saved, you deserve to keep it and to use it for your own security and happiness. Do not let someone take it from you, whether through fraud or through bad advice or through products that benefit them more than they benefit you. You know, I think about my own mortality more these days. I am in my 90s. I have lived a long life, a good life. I've been very fortunate. And I know that I do not have decades left ahead of me. Maybe I have a few more years, maybe more than that if I'm lucky. But the clock is ticking. And when you get to be my age, you start thinking about what really matters, what you want to leave behind, what you want people to remember. And one of the things I want to leave behind is this message, this warning, because I have seen too much. I have lived through too many cycles. I have watched too many people make the same mistakes over and over again. And I do not want to see another generation of retirees get wiped out because they were not prepared, because they did not see it coming, because nobody warned them loudly enough or clearly enough. So I am using whatever credibility I have left, whatever platform I still have, to tell you this. We are living in dangerous times financially. The risks are real. The stakes are high. And if you are over 60, you do not have time to wait and see how things play out. You need to act now. You need to take steps now to protect yourself and your family. Does that mean selling everything and moving to cash? No. I have already said that is not what I am recommending. What I am recommending is that you take a hard, honest look at your situation, that you stress test your plans, that you make sure you are not taking more risk than you can afford, that you have reserves, that you have flexibility, that you are not counting on everything going perfectly, because it probably will not. And here is the thing. If I am wrong, if the market keeps going up, if we avoid a major crisis, if inflation stays under control, if everything works out fine, what have you lost by being cautious? Maybe you earned a little bit less return than you could have. Maybe you missed out on some gains. But you still have your principal. You still have your security. You can still sleep at night. That is not a bad outcome. But if I am right, if we do hit a rough patch and you are not prepared, the consequences could be devastating. You could lose a big chunk of your savings at a time when you cannot afford to lose it. You could be forced to cut your lifestyle dramatically. You could end up depending on your children or other family members. You could spend your final years worried about money instead of enjoying them. And that is a tragedy. That is something I desperately want you to avoid. So please take this seriously. Do not dismiss this as just another person making predictions. I am not trying to sell you anything. I do not have a product or a service. I am not trying to scare you into buying gold or Bitcoin or whatever else people are pushing these days. I am just trying to share what I have learned over more than 70 years of watching markets and economies and human behavior. And what I have learned is this. The people who survive and thrive over the long term are not the ones who take the biggest risks or make the biggest bets. They are the ones who manage risk carefully, who think about what can go wrong, not just what can go right, who build their lives and their finances on a solid foundation, not on speculation and hope, who understand that wealth is not just about making money, it is about keeping it. Charlie Munger, my partner for so many decades, he used to say that the first rule of compounding is to never interrupt it unnecessarily. What he meant was that the real power of investing comes from time, from letting your money grow and compound over years and decades. But you cannot do that if you blow yourself up. You cannot compound if you lose half your money in a crash and have to start over. The key is to stay in the game, to survive, to make sure you are still standing when the dust settles. And that is especially true when you are older, because you do not have as much time to recover. You do not have decades for your money to compound back to where it was. You need to protect what you have. You need to be the tortoise, not the hare. Slow and steady, conservative and careful. It is not exciting. It is not going to make you rich quick, but it is going to keep you secure. And at this stage of your life, security should be your number one priority. Let me tell you about something else I have been thinking about. and that is the role of family. Because when you are planning for retirement, when you are thinking about your finances, you are not just planning for yourself, you are planning for your spouse if you are married. You are planning for your children and grandchildren who might depend on you or inherit from you. You are part of a larger family system, and your decisions affect all of them. I have always believed that one of the most important things you can do for your family is to not be a burden, to take care of yourself, to be financially independent for as long as possible. Because when you are not, when you run out of money or make bad decisions that force your children to step in and help, it creates stress and strain on those relationships. It puts your kids in a position where they have to choose between their own financial security and taking care of you, and that is not fair to them. So part of being conservative with your finances right now is thinking about that, thinking about making sure you do not outlive your money, making sure you do not put your family in a difficult position down the road. And that means planning for the worst case, not the best case. It means building in that margin of safety we talked about earlier. It means making choices today that might not maximize your returns, but will maximize your security and independence. And if you do have some wealth to pass on, if you are in a position where you are going to leave an inheritance, think carefully about how you want to do that. Think about whether you want to give some of it away while you are still alive so you can see the impact. Think about whether your children are ready to handle an inheritance responsibly or whether they need guidance or structure around it. Think about your values and what you want to teach the next generation about money and work and responsibility. I have given away most of my wealth. I pledged it to charity years ago. And I did that because I believe that concentrating huge amounts of wealth in families, generation after generation, is not healthy. It is not good for the people who inherit it, and it is not good for society. But that is my personal view. Your situation is different. You might not have billions to give away. You might be trying to figure out how to leave your kids enough to help them, but not so much that it ruins them. That is a delicate balance. And it requires thought and planning and honest conversations with your family about expectations and values. You know, there is something else I want to address, and that is the idea that you can time the market, that you can figure out exactly when to get in and when to get out, that you can sell at the top and buy at the bottom. I have been doing this for over 70 years, and I cannot do it. Charlie could not do it. Nobody I know who has been successful over the long term has been able to do it consistently. And yet, people keep trying. They keep thinking that this time they will be the one who gets it right. Let me save you a lot of frustration and probably a lot of money. You cannot time the market. Nobody can. Oh, sure, somebody might get lucky once or twice. They might sell before a crash or buy before a rally. But that is luck. That is not skill. And luck does not repeat. The people who try to time the market consistently end up buying high and selling low. They end up missing the best days because they are sitting in cash waiting for the perfect entry point. They end up paying more in taxes and transaction costs because they are constantly trading. What works, what has always worked, is having a sensible asset allocation based on your situation and your needs, and then sticking with it, rebalancing occasionally when things get out of whack, but not trying to jump in and out based on your predictions about what the market is going to do next month or next quarter, because those predictions are going to be wrong more often than they are right. Now, I know what some of you are thinking, but Warren, you just spent all this time telling us that the market is overvalued and that we should be cautious. Is not that market timing? And the answer is no, not really. What I am talking about is asset allocation. I am talking about making sure that at this stage of your life, you are not taking more risk than you need to or can afford to take. I am not telling you to sell everything today and buy it all back when the market drops 20%. I am telling you to make sure your portfolio is positioned appropriately for your age and your circumstances. There is a big difference between those two things. Market timing is about making tactical bets on short-term movements. Asset allocation is about having a strategic framework that makes sense for your situation. One is speculation, the other is planning. And planning is what you should be focused on. Let me talk about something practical now. Estate planning. Because if you are over 60, you need to have your affairs in order. You need a will. You need power of attorney documents. You need health care directives. You need to make sure that if something happens to you, your wishes will be carried out and your family will not be left scrambling trying to figure out what you wanted. I have seen too many situations where someone dies or becomes incapacitated and they did not have proper documents in place. And it creates chaos, it creates conflict among family members. It results in outcomes the person never would have wanted. And all of it could have been avoided with a few hours of work and a modest legal fee. So if you have not done this yet, do it now. Go see an estate planning attorney, get your documents drafted and signed, tell your family where they are, tell them who your executor is, who has power of attorney, what your wishes are for end-of-life care. Have those conversations even though they are uncomfortable, because not having them is going to be a lot more uncomfortable for everyone involved when the time comes. And while you are at it, review your beneficiary designations on your retirement accounts and life insurance policies. Make sure they are up to date. Make sure they still reflect what you want, because those designations override what is in your will. A lot of people do not realize that. They update their will, but forget to update their beneficiaries, and then the money goes to the wrong person. Or it goes to an ex-spouse from 30 years ago because nobody ever changed the form. These are not exciting things to think about. They are not fun things to do, but they are important. They are part of being responsible. They are part of taking care of your family. And if you care about the people you are going to leave behind, you will make sure this stuff is handled properly. Now, let me come back to the bigger picture for a moment, because I want to make sure I am not just giving you a list of worries without also giving you some hope, some perspective. Because yes, we are facing challenges. Yes, there are risks. Yes, things might get difficult. But we have been through difficult times before. We have faced challenges before. And we have always come out the other side. This country, America, it has been through a civil war. It has been through 2 world wars. It has been through a Great Depression. It has been through stagflation in the 70s. It has been through multiple financial crises. And every single time, people thought it was the end. They thought we would never recover. They thought this time was different. And every single time, they were wrong. We did recover. We came back stronger. The economy grew. Businesses thrived. Innovation continued. And I believe we will do it again. I believe in the resilience of American business. I believe in the creativity and work ethic of the American people. I believe in our system. Even though it is flawed and messy and frustrating, it works. It has worked for 250 years. And I think it will keep working. But that does not mean you can be complacent. That does not mean you can ignore the risks. That does not mean you should just assume everything will be fine without taking any steps to protect yourself. Hope is not a strategy. Optimism about the long term does not excuse poor planning in the short term. What I am trying to give you is realistic optimism. Optimism rooted in history and facts and a clear-eyed assessment of where we are. Optimism that says, yes, we will get through this, but we might have some tough years ahead first. Optimism that says your job is to make sure you personally are positioned to weather those tough years, to come out the other side intact, to still be standing when things turn around, because they will turn around. Markets always do. Economies always do. But in the meantime, you need to take care of yourself. You need to be smart. You need to be careful. You need to have a plan and stick to it even when it is hard. And that is really what this whole message comes down to. I am not trying to predict exactly when or how the next crisis will hit. I do not know. Nobody knows. What I do know is that we are in a vulnerable position, that the risks are elevated, that people who are not prepared are going to have a very hard time, and that you still have time to prepare. You still have time to make adjustments. You still have time to protect yourself and your family, but that time is not unlimited. The longer you wait, the fewer options you have. The closer we get to a crisis, the more expensive it becomes to protect yourself. So act now. Do not put this off. Do not tell yourself you will deal with it next month or next year. Deal with it today, this week. Make the phone calls. Review your accounts. Talk to your advisor. Have the conversations with your family. Take the steps. I want to leave you with one final thought, and it is this. Your financial security in retirement is not just about the numbers. It is not just about how much money you have in your accounts or what your portfolio returns are. It is about peace of mind. It is about being able to enjoy these years without constant worry. It is about having the freedom to spend time with people you love, to do things you enjoy, to live with dignity and independence. And that peace of mind comes from being prepared, from knowing that you have thought through the risks, from knowing that you have a plan, from knowing that even if things go wrong, you will be okay. You will still have enough. You will still be able to take care of yourself. That is what I want for you. That is what all of this is about. I have had the privilege of financial security for most of my adult life. And I can tell you that the real value is not in being able to buy expensive things or live lavishly. The real value is in not having to worry and knowing that no matter what happens in the economy or the markets or the world, you and your family are going to be fine. That is priceless. That is worth more than any amount of extra returns you might squeeze out by taking unnecessary risks. So as you think about what I have said today, as you consider whether to make changes to your financial situation, ask yourself this question: what would give me the most peace of mind? What would let me sleep better at night? What would make me feel secure and confident about the future? And then do that, even if it means giving up some potential upside, even if it means your accounts do not grow as fast as they might otherwise, because peace of mind is worth the trade-off. I think about the people who wrote to me over the years, people who lost money in crashes, people who made mistakes, people who wish they had been more careful. And the common thread in almost all of those letters is regret. Regret that they did not see it coming. Regret that they did not listen to the warnings. Regret that they took risks they did not need to take. And I do not want you to be writing that letter 5 years from now. I do not want you to look back and wish you had acted when you still had time. This is your moment. This is your opportunity. Right now, today, you can make choices that will protect your future. You can take steps that will give you security. You can build that margin of safety that will let you weather whatever storms are coming. Or you can ignore this. You can tell yourself it will all work out. You can keep doing what you have been doing and hope for the best. But hope is not enough. Hope does not pay the bills. Hope does not protect your savings from a market crash or high inflation or unexpected medical expenses. Action does. Planning does. Making smart, conservative decisions does. I am 90-something years old. I have lived through more economic cycles than I can count. I have seen boom and bust. I have seen panic and euphoria. I have seen people make fortunes and lose fortunes. And through it all, the one constant has been this: the people who plan ahead, who think about risk, who build in safety margins, who do not get swept up in the excitement of the moment, those are the people who survive. Those are the people who thrive over the long term. Those are the people who can look back on their lives without regret. So be one of those people. Be smart. Be careful. Be prepared. Take this warning seriously. Not because I am Warren Buffett and I have some special insight, but because the facts, the data, the history, all of it points in the same direction. We are in a risky environment. We are late in the cycle. We are vulnerable. And if you are over 60, you cannot afford to get this wrong. I hope I am wrong. I really do. I hope the market keeps going up. I hope we avoid a major crisis. I hope inflation stays under control. I hope all of your plans work out exactly as you envisioned. But I have been around long enough to know that hoping is not the same as planning. And right now, what you need is a plan. So make one, review your situation, talk to people you trust, get professional advice if you need it, but do something. Do not just sit there and wait to see what happens, because by the time you know what is happening, it might be too late to do anything about it. I care about this. I care about you. I care about the millions of people out there who worked hard their whole lives and deserve to enjoy their retirement without financial stress. And that is why I am speaking up. That is why I am using whatever platform I have left to get this message out. Because somebody needs to say it. Somebody needs to warn you. Somebody needs to tell you the truth, even if it is uncomfortable. The financial system is fragile. The economy is vulnerable. The markets are expensive. The risks are real. And if you are not prepared, you could lose a lot, maybe everything. But if you are prepared, if you take action now, you can protect yourself. You can secure your future. You can have that peace of mind I talked about. So please, I am asking you, I am urging you, take this seriously. Act now. Do not wait. Do not procrastinate. Do not tell yourself it will be fine. Make the changes you need to make. Have the conversations you need to have. Build the safety net you need to build. And then, when the storm comes, and it will come, you will be ready. You will be safe. You will be okay. That is all I can do. That is all anyone can do. Warn you, give you the information, share their perspective, but the rest is up to you. The choices are yours. The actions are yours. The future is yours to shape. And I hope, I truly hope, that you will choose wisely, that you will act prudently, that you will protect what you have worked so hard to build, because you deserve security. You deserve peace. You deserve to enjoy these years without fear or worry. And if you take the right steps now, you can have that. You really can. But only if you act, only if you prepare, only if you take this warning to heart and do something about it. So that is my message. That is what I wanted to say. This is serious. This is urgent. This is your last warning. If you are over 60, act now, protect yourself, prepare for what is coming. And whatever you do, do not ignore this, because the cost of ignoring it could be more than you can afford to pay. Thank you for listening. Thank you for taking the time. And I wish you all the very best in the years ahead. Stay safe, stay smart, and take care of yourselves and the people you love.